What would you do if you found out that everything you believed about money is a big lie? Living in a world where the value we give to money is an illusion created by ourselves. In this video, we will unveil the hidden truth behind money and how this perception can transform your life. Have you ever felt trapped in an endless cycle of work and debt, seeing no way out? Have you ever wondered why, despite working so hard, money never seems to be enough? This video will reveal how the illusion of money influences every aspect of our lives, from our daily decisions to our biggest dreams. Understanding this illusion is the first step to achieving financial freedom and taking control of your future. Watch until the end and discover how this new perspective can change the way you view, earn, and invest your money. Are you ready to transform your relationship with money and achieve true prosperity? Let's take a moment to think about the inventions that have shaped our civilization. Imagine living in a world without fire or without the wheel. Fire gave us warmth, security, and the ability to cook our food. The wheel revolutionized transportation and trade, allowing people and goods to move efficiently. But what if I told you there's an even more transformative invention that often goes unnoticed? Yes, we're talking about money. Unlike fire and the wheel, the creation of money is not something you can touch or see directly. It's an idea, a social construct that we've created to facilitate our lives. At first glance, money may seem like just a medium of exchange, but it goes far beyond that. It is what sustains our global economy. Before money, our ancestors relied on bartering to exchange goods and services. Imagine the difficulty of exchanging a sack of grains for a pair of shoes. Exchanges were direct, and each person had to find someone who wanted exactly what they had to offer and who also had what they needed. It was a real gymnastics to make exchanges work, and the lack of a standardized value made everything even more complicated. It was in this context that money emerged as a brilliant solution. Instead of directly exchanging one good for another, we began to use objects that represented value, such as shells, salt, and precious metals. This made exchanges much more efficient. It was no longer necessary to find an exact match between what you had and what you needed. You could simply use money to buy whatever you wanted, from whoever. Over time, the concept of money has evolved. From shells and salt, we moved to metal coins, and eventually to the paper currency we use today. Each of these stages brought new advantages and challenges, but the impact of money on society remained immense. It not only facilitated trade, but also allowed people to accumulate wealth in ways that were previously impossible. But let's talk about the true nature of money. Money, at its core, is nothing but an idea, a mental construct that we all accept and follow. But why do we say that money is an illusion? To understand this, we need to reflect on what truly gives value to money. Imagine for a moment that you are holding a $100 bill. This piece of paper itself has no intrinsic value. It's not edible, it doesn't serve to build anything, and certainly can't be used as fuel. What truly gives value to this bill is the trust that we all, collectively, place in it. It's a social agreement. We all agree that this bill can be used to buy goods and services, pay debts, and save for the future. But this trust is extremely fragile. If at any moment people stop believing in the value of this paper, it becomes just a worthless piece of paper. This has happened several times throughout history with different currencies, leading to episodes of hyperinflation where money literally became worthless. When we say that money is an illusion, we are highlighting that its value is not absolute but relative to the trust we have in it. This trust is influenced by numerous factors, such as economic stability, government policies, and even international crises. When the economy is strong and stable, trust in money is high. When there are crises, wars, or poor economic management, this trust can plummet. Moreover, modern money is fiat, which means it is not backed by a physical asset like gold or silver. In the past, money notes could be exchanged for an equivalent amount of gold. Today, this is no longer true. The money we use is not backed by tangible assets. It holds value because the government decrees it does. Recognizing that money is an illusion opens our eyes to the importance of investing in assets that have intrinsic value or that can grow in value over time. Real estate, stocks, precious metals, and even cryptocurrencies, depending on your strategy and risk tolerance, can be ways to protect and increase your wealth more safely and efficiently than simply storing money under the mattress. Understanding the illusion of money also helps us to be more critical of the economic decisions governments make. When governments print money without a corresponding increase in the production of goods and services, it can lead to inflation, decreasing the value of our money. This is where the idea of using commodities as money came about. This transition to commodity money was a crucial step in the evolution of our financial system. By solving many of the problems of bartering, it allowed economies to become more complex and interconnected. People could now save, invest, and plan for the future with greater security and predictability. The first coins were minted around the 7th century BC in the region of Lydia, in what is now Turkey. These coins were made of a mixture of gold and silver called electrum. Coinage brought several significant benefits. First, coins had a standardized value, which facilitated transactions. Each coin represented a specific quantity of precious metal, eliminating the need to weigh and measure value in every exchange. Additionally, coins were easy to transport and divide. Instead of carrying metal bars or bags of grains, people could carry small coins in their pockets, ready to use at any time. This not only facilitated local trade but also encouraged long-distance trade, as merchants could travel with greater security and convenience. However, the creation of coins also brought its own challenges. One of the main problems was ensuring the authenticity and value of the coins. Initially, coins were made of precious metals that had intrinsic value, but soon, kings and rulers realized they could increase their wealth by manipulating the metallic content of the coins. They began to mix precious metals with cheaper metals, decreasing the coin's real value while maintaining the same nominal value. This practice, known as debasement, created a dilemma. People began to distrust the value of coins, which could lead to inflation. If the coins did not contain the amount of precious metal they promised, their value decreased, and the prices of goods and services increased. This phenomenon is similar to what happens today when governments print more money than the economy can support, leading to currency devaluation and increased inflation. Another challenge was counterfeiting. With the growing popularity of coins, criminals began to counterfeit them, using cheap metals to create coins that looked genuine. Governments had to develop methods to combat counterfeiting, such as introducing complex designs and authenticity marks on coins. Nevertheless, counterfeiting remained an ongoing problem, forcing authorities to constantly innovate to protect the integrity of the monetary system. Moreover, the introduction of coins changed the social and economic dynamics. Wealth accumulation became easier and more accessible, but it also began to create more pronounced wealth disparities. Those who controlled coinage, usually rulers and elites, had a significant advantage over the general population. This led to greater concentration of wealth and power in the hands of a few. On the other hand, the standardization of coins facilitated economic growth and the development of cities. Markets and fairs became vibrant centers of trade, where people from different regions could exchange goods and services more easily. Coins also allowed for the development of banking and credit systems, which in turn drove economic growth. Now that we've seen how coins revolutionized trade and the economy, let's explore a crucial and often problematic aspect of the history of money: the manipulation of monetary value. With the creation of coins, rulers realized they had a powerful tool in their hands to control the economy and increase their own wealth. Let's understand how this manipulation worked and what its consequences were. Soon after the introduction of coins, rulers found they could alter the metallic composition of coins to increase their wealth. As mentioned earlier, this was done by mixing precious metals, such as gold and silver, with cheaper metals like copper. This practice, known as debasement, allowed kings and emperors to produce more coins with the same amount of precious metal, essentially creating more money out of thin air. To better understand, imagine an original gold coin containing 10 grams of gold. If the ruler decided to mix this gold with copper, each coin could contain only 5 grams of gold and 5 grams of copper. This meant that with the same amount of gold, the ruler could mint twice as many coins. On the surface, it seemed like there was more wealth available, but in reality, the value of each coin was lower. This practice had significant consequences. Firstly, confidence in the coins began to decline. People realized that the new coins did not hold the same value as the old ones. In the modern world, manipulation of monetary value continues to be a common practice, but in different forms. governments and central banks use monetary policies to influence the value of their currencies. An example of this is money printing. When a government decides to print more money, it is essentially increasing the money supply. If the quantity of goods and services in the economy does not increase in the same proportion, this leads to inflation, exactly as it happened with the devaluation of old coins. To illustrate, think about what happened during the 2008 financial crisis and the COVID-19 pandemic. In both cases, many governments, including the United States, resorted to printing large amounts of money to stimulate the economy. While this may have helped avoid an immediate economic depression, the long-term consequence was a significant increase in inflation. Prices of goods and services rose, and the value of money decreased. Another example of manipulation of monetary value is the interest rate. Central banks, like the Federal Reserve in the United States, adjust interest rates to control inflation and stimulate or slow down the economy. When interest rates are low, borrowing money becomes cheaper, which encourages consumption and investment. However, this can also lead to an increase in inflation if the economy is overheating. On the other hand, raising interest rates can help control inflation, but it can also slow down the economy by increasing the cost of borrowing and discouraging consumption and investment. Manipulation of monetary value, whether through the devaluation of old coins or modern monetary policies, has a profound impact on the economy and people's lives. Understanding these dynamics is essential for making financial decisions. When investing, it is important to consider how inflation and monetary policies can affect the value of money and assets over time. As we continue the story of money, we come to a crucial phase, the adoption of paper currency and IOU certificates. This stage marked a significant transformation in how we deal with money, bringing both convenience and new challenges. Before the introduction of paper currency, transactions were mainly conducted with metal coins, such as gold and silver. Although coins were a significant improvement over the barter system, they still had problems. Metal coins were heavy and difficult to transport in large quantities, especially for merchants who needed to travel long distances. Additionally, the risk of theft was high because carrying many coins of value made people easy targets for thieves. Then came the idea of paper money. The concept was simple yet revolutionary. Instead of carrying precious metals, people could use paper notes representing a specific value. These notes could be exchanged for gold or silver when needed. Initially, paper money was issued by banks and backed by a reserve of precious metals, inspiring confidence in people. The earliest examples of paper money emerged in China during the Tang Dynasty, 618 to 907 AD, and became more common during the Song Dynasty, 960 to 1279 AD. Chinese merchants began using exchange notes to facilitate commercial transactions. These notes were promissory notes that could be exchanged for cash at a later date. This system proved so efficient that the Chinese government began issuing its own paper money. The concept of IOUs, or IOU, also began to gain popularity. An IOU is essentially a written promise of payment. It was a way to formalize a debt and ensure that the creditor would receive payment at a future date. This allowed people to conduct transactions even without having the full amount of money on hand at the time. IOUs could be passed from one person to another, further facilitating commercial exchanges. In the West, paper money began to be adopted in the 17th century. In 1694, the Bank of England was founded and began issuing banknotes, which could be exchanged for gold coins. These notes quickly gained acceptance and became a standard form of money. The success of paper money in the UK inspired other countries to adopt similar systems. The use of paper money and IOUs brought several benefits. Firstly, it made transactions safer and more convenient. Paper notes were lightweight and easy to carry, reducing the risk of theft and facilitating trade. Additionally, paper money allowed economies to grow, as people could conduct high-value transactions without needing to carry large quantities of precious metals. However, the adoption of paper money also brought new challenges. Confidence in the value of paper money depended on the assurance that it could be exchanged for precious metals. If people lost confidence in this guarantee, the value of paper money could plummet. Additionally, the excessive issuance of paper money by governments, without corresponding reserves of precious metals, could lead to inflation. Over time, many countries abandoned the gold standard, where the value of paper money was directly linked to a specific quantity of gold. Instead, they adopted a fiat currency system, where the value of money is determined by trust in the issuing government's economic stability. Today, most currencies in the world are fiat, meaning they have no intrinsic value but are accepted because everyone trusts they can be used to purchase goods and services. As we progress in our exploration of money, it's time to discuss a topic that directly affects everyone's lives: inflation and the modern issues associated with manipulating monetary value. Let's understand how inflation works, why it occurs, and what you can do to protect your finances against its effects. Inflation is the continuous increase in the prices of goods and services over time. When prices rise, the purchasing power of money decreases, meaning you can buy less with the same amount of money. For example, if the annual inflation rate is 3%, something that costs $100 today will cost $103 next year. It may seem like a small difference, but over time, inflation can significantly erode the value of your money. There are several reasons why inflation may occur, but two of the main ones are demand and supply of money in the economy. Firstly, we have demand pull inflation. This occurs when the demand for goods and services exceeds the available supply. If many people want to buy the same products, prices tend to rise. This can occur in a growing economy where more people have employment and income to spend. Then, we have cost push inflation. This occurs when the cost of producing goods and services increases and producers pass these costs on to consumers. For example, if the price of oil rises, transportation and production costs also increase, leading to higher prices for many products. Another common form of inflation is monetary inflation. This occurs when there is an increase in the quantity of money in circulation without a corresponding increase in the production of goods and services. When governments print more money to finance expenses without an increase in production, this often leads to inflation. High levels of inflation can create uncertainty in the economy. Businesses may delay investments and hiring because they are unsure of what their costs and prices will be in the future. This uncertainty can slow down economic growth. To combat inflation, central banks often raise interest rates. Higher interest rates make borrowing more expensive, which can reduce consumption and investment. This can slow down the economy and even lead to recessions. Inflation can disproportionately affect different groups of people. Those who own assets that increase in value with inflation, such as real estate or stocks, may benefit. In contrast, those who rely on salaries or savings may see their purchasing power erode. To protect your finances from inflation, investing in assets that outpace inflation is a key strategy. Stocks, real estate, and other assets have historically outpaced inflation, helping to protect and increase your wealth. Additionally, consider investing in inflation-linked bonds. Throughout this video, we explored the evolution of money, from the barter system to the modern illusion of fiat money. We've seen how money, although an abstract idea, plays a crucial role in our lives. Understanding how money works, from its origins to current economic policies, is essential for making smart financial decisions. Understanding the illusory nature of money allows us to see beyond the notes and coins, recognizing that its value is sustained by collective trust. This helps us make more informed choices about how to save, invest, and protect our wealth. Wizard, if you found this video helpful and want to learn more about money, don't forget to subscribe to our channel and turn on notifications so you don't miss any of our future videos. Leave a like if you enjoyed the video and share it with friends and family who may also benefit from this knowledge. And of course, we want to hear from you. Leave a comment below with your questions or experiences about personal finance. Thank you for watching and allowing us to be part of your financial journey. Together, we can transform the way we understand and manage money, achieving a more prosperous and secure life. Until the next video,